Good afternoon, ladies and gentlemen. Welcome to the webinar, Investment Readiness, from the University of Essex Space to Grow programme. We're just going to wait a few more minutes for attendees to join us. So you've got time to make a quick cup of coffee. If it is a quick cup of coffee, probably not enough time to brew a cup of tea though. We'll just keep waiting just a little bit longer. Thank you. This is a programme, a series of webinars, which are available to businesses in the local area and beyond who are interested in raising investment funding for their business or are considering going down the route of raising investment funding for their business. We have on board today a panelist, Michael Berger, who is from BDO, a very prominent accounting firm. And Michael's background is in investments. He has been involved in a number of serious large-scale investment opportunities and has advised a number of companies on that process. And we welcome him today. Thank you very much, Michael. Now, before we start off, just a couple of little housekeeping rules. We have got everybody on mute. If you wish to ask any questions at all, we have the Q&A either at the bottom, top or side of your screen, depending on which device you're looking through. And we would welcome those questions and we will endeavour to answer all questions which have come forward. And thank you to those who have already submitted their questions to the panellists. We appreciate those questions in advance, always helpful, but we're more than happy to answer questions as we go through this process. The webinar is being recorded. The copies of the webinar will be available shortly after the event, should you wish to review it and go through the points again. As I say, this is part of a series of webinars, so please join us. There's another one at 2 o'clock tomorrow. The invitations will be going out. Thank you very much for those who attended last week's as well, and I hope you enjoyed that. Now, before we start, I'd like to actually just ask you a very simple question. So I'm actually going to ask you a simple poll to start the process, just to get the flavour of how we're going to operate today. So without further ado, I will start you with the first question. Have you already decided on your investment strategy? And there you will see that 3/4 of you have already decided on your investment strategy. So we will be asking that question at the end and we'll see whether anybody's changed their mind. So without further ado, I would very much like to introduce you to Michael Berger, and I would like Michael Berger to start sharing his screen with his presentation. Michael, over to you, please.
Thanks, John. Thanks, John. I'm just going to share my screen with you. Take 1 moment. Okay, so can everyone see my screen?
Yes, we can see you fine. We can see you fine. Thank you.
Perfect. So hello everyone. Thanks for joining today. I hope you didn't have the same introduction to this meeting as I did. Fire alarm and having to go down 7 stories and back up 7 stories. So I do apologise for any lack of breath, but we will get straight onto it. So just a quick introduction. I actually want to try and base this more around a Q&A. And focus this on the attendees rather than just what I've got to say. So I've got a lot of slides, but I'm just going to be firing through them and really focus on questions. About myself, so I'm Mike Berger. I work in what's called growth advisory for BDO. BDO background, I won't go into it too much, but 5th largest accounting firm. I work within what's called M&A, mergers and acquisitions. Growth advisory just does fundraisers. So we typically raise between 2 and 10 million. Often that's a Series A, which we'll come on to later. I'm sure most of you already know what that is. But we do see a lot of earlier opportunities as well. And previous to my role with BDO, I actually sat on the judging panel for Northwest Business Angels, as well as running the Stockport Business Angels events each year with my former employer. So just in terms of who we work with, apart from Series A, we also work with MBOs, and we're meant to be sector agnostic, but to be honest, everything that's high growth at the moment seems to be tech. So we almost predominantly work on tech. What we've discovered during lockdown, even though technically we're sort of out of it and then back into it, tech businesses have carried on raising money. There's absolutely no doubt about it. We went into processes at the start of lockdown, and we're just coming to those completing now. But it showed there's still appetite all the way through, and people are still, or investors are still there with dry powder or cash to invest, and they're happy to invest in the right opportunities. Certainly those that support what we're doing right now, which most of us working from home. So let's move on to our first poll, if we can. So I've put the question on here, but appreciate that Josh and Chris are going to share this. So I'm really interested in knowing which type of business yours is. Appreciate I've not put a massive list there, but if you can give me some feedback, just that I can base the presentation a bit more in your favour. So we'll just do this fairly quickly for those of you who would prefer to say. You can always put in the chat as well if it's very different. Okay, nice mix so far. A lot of people going for other. Clearly we didn't cover enough categories. Okay, one in SaaS tech, augmented reality, creative digital, and then quite a lot in other products and other service. So it'd be quite interesting if everyone wants to share on the chat and get involved and share, and say what they're doing. You don't have to, but it will help me to tailor some of the Q&A and some of the slides. So thank you very much for that. Let's move on. So funding landscape. This is from Q1 of 2020. The Q2 statistics are already available, but ultimately what I wanted to get across here is that there has been an increase in investment this year, or certainly the first quarter, compared to the same period the previous year. Yes, COVID saw a dip, but it depends on the sector. So again, for most of you, and it'll be interesting to see in the chat where your businesses sit, but for most of you, you'll probably see that there's a number of investors out there looking for the next best thing, looking for the next investment for them, and they have funds that they have to deploy. So with regards to UK venture, no one needs to know how big it is, even though the stat is there. It's huge. There's plenty out there. There's plenty of investors, lots of sector expertise. When it comes to the government this year, it's been a really interesting year. So what we've seen is, perhaps not for brand new startups, but for startups that had raised previously at least 250k, the Future Fund was launched. Initially for about 450 million, and they had to take the cap off that because lots of players wanted to raise more money. Again, if you've got any questions about anything I say throughout this, you're welcome to ask in the Q&A or follow up. Future Fund was the most interesting because it allowed people to effectively borrow money without, take money out on a convertible loan note, so they could actually potentially pay it off as debt if they were doing well, or it would convert into equity after a period of time. As you're all aware, I'm sure, the grants that are available, there's a huge number of grants at the moment, and have been for some time. A lot of people are worried about the European landscape and what that's going to do to the grant market, but there's still a lot of capital available if you go to the right sources, the Innovate UKs and so on. R&D tax credits, I am sure that you've all covered this. So again, these are more for other sessions, but I just want to make sure that if you haven't, you've seen it once and you can ask a question later. This is where you're developing a platform, or you're developing your business, and effectively you can get back a number of tax breaks, or in fact you can get the credit back, so you can get cash back straight into the business after you've filed your accounts. The final thing on this list is SEIS, EIS, and VCT, which again there's a webinar tomorrow being in detail about the tax schemes. If you don't know what SEIS and EIS are, you need to learn about it if you're a business that's less than 7 years old. Effectively, these are tax schemes where angel investors can come in, invest their money, and if it does go wrong, they're covered up to a certain percentage. In addition to that, they get some tax breaks immediately. So if they're investing 10,000, they may get certain tax breaks on capital gains and income tax, all the stuff that, again, the tax guys will share with you. Just going to quickly have a look at this chat, and appreciate you can all see my screen, but just to see if there's any questions that have come through. So, okay, so nothing yet. Okay. So in terms of investor profiling, a lot of you are here to hear about angels and also to learn about venture capital. There is quite a difference, but it's amazing the difference between, say, the UK and America, because the UK has a lot of these tax schemes. So there is a huge market for angel investors at the very early stage. People will invest into ideas. Where it comes to venture capital, there are still some funds out there that effectively pool these types of investments together, so EIS funds, and they will invest earlier stage. There's also VC funds that purely have investors looking for the next best thing, so looking for the next huge scale up, looking for the next Uber or the next Deliveroo, for instance. They often like to see traction. So a lot of people that are looking for a VC need to demonstrate that there's some contracts in place, or they've built, the tech is already there. Whereas an angel investor tends to come in earlier. It's not to say that VCs won't invest at the very start. There are some that do. There's also certain VCs out there now that will invest a much smaller amount and take a risk. There's certain, there's different things out there that similar to this, where angel group, where there's money dedicated to it, and they can effectively plug a gap if it's required. But whilst understanding the VC and angel networks, before you go to one of these, you should really ask yourself the question: do you just want the money, the capital, or do you need a supportive partner? And that will help you to answer which VC or which angel you go to, and how you arrive at them. So, as I've stated on here, there are a lot of angels. Some are dentists, doctors, and so on, who just have money and they want to invest. Some are ex-entrepreneurs or people that have sold their businesses previously or have another business and they're just interested. They want to make a turn on their money, and they will look for something interesting and a nice management team to work with. In terms of being a supportive partner, how can they support you? Without going into too much detail on EIS and the restrictions around it, because there are restrictions around connected parties, which they'll go into tomorrow. If you do have an angel or a VC, there's lots of different types, and certain VCs will take things like, which we'll go into detail on afterwards, board seats or observer rights to sit on the book to observe your board meetings. Angels, potentially, if they're not restricted by tax schemes, they can also be quite heavily involved in the business if you need them to be, or make introductions where required. So the areas that they can support are strategy, of course, if they've been there and done it. If it's a dentist, perhaps they could help on if you're a start-out dentist, but that's unlikely. On the finance side, often you'll have people like myself that look for opportunities and look for where there's a skill gap missing. So where I invest into companies, I'll look for a business that doesn't have finance knowledge potentially, or just has a basic grasp, and I can then add on to that. With regards to introductions, again, network for funding rounds, network for sales, network for affiliations with other businesses that you can sell through. If you're in the areas that you've discussed before, then you absolutely can leverage affiliate networks at the start to instead of spending large amounts on marketing. So often it depends on your business model. If you're B2B, B2C, depends on how much you're going to have to spend on marketing. Sector knowledge, again, if they've been in a business in your sector, then of course they will be able to give you that knowledge. The other areas are a bit more for the latter end. So internationalization. Is your business ready for that? Often we argue when we're looking at a company that when you're going for a funding round, maybe not at the angel or VC, early VC stage, you need to demonstrate that your business has the potential to do so, but not necessarily has started to do yet. That's more for the latter rounds. That's more for the Series A. If you have done it already, fantastic. But ultimately, it's about getting to certain key milestones within the business, and it is a matrix of items. Acquisitions as well. It's more for the latter stages, so it's more about bringing businesses together. In terms of areas to focus on, so again, look at the angel or the VC's track record. Are they a sector specialist? VCs, for instance, there's let's give an example. In Motion Ventures, which is a VC arm, a corporate VC arm of Land Rover, Jaguar Land Rover. They specialise in logistics and motor. That if you're in that space, fantastic VC to approach. They will have sector expertise. In terms of the sweet spot size and sector, most VCs will state the level of investment that they will come in at. It can vary massively. There are VCs that put out huge checks. There are VCs that stick to this end of the market as well, at the very, very early stage. Fund cycle is important. So again, interestingly, there are funds out there that are not what's called evergreen. They have to effectively raise their funds and then deploy them and then raise another fund. Sometimes it overlaps. What that means technically is you might be talking to someone that has a great deal of interest in your business, but at the end of that, they don't have the cash to deploy straight away. They have to wait until the fund has been raised, and they can do that. At that point, and they're just trying to fill their pipeline of deals. Post-deal approach, again, it's more for the latter stages of a fundraise. So they are going to speed up these slides, just to let you know. So they're going a little bit slow at the moment, but we'll most certainly speed up. So with regards to, I'm just having a quick look if there's any questions here. Okay, we'll come on to these afterwards because I think we'll probably cover a number of the things that have been asked so far as part of the next steps. So if you are a business that's disruptive, if you are a business that's gaining traction, you don't always have to be first to market, but certainly for the VCs, you tend to have to be, or have to have a differentiator. Being a cost leader is not necessarily the best way. Often that isn't looked upon favourably unless you're doing something so different that it allows you to be a cost leader. And then the question is, why are you being a cost leader? With regards to choice, if you have such a business, if it's fantastic, it ticks a lot of the boxes, and you have the difference between the two. So in here, an average angel investment can be as low as 25k. Yes, that's per individual. Yes, there are syndicated funds. Yes, there's co-investments, matching funds, all of these different things that are available in the market. But what's special about angels is they can invest very early, and there is more money available very early to invest in ideas and a management team that can then build the products to then sell or build the service. Again, SEIS and EIS has an impact on connected parties, control, and whether they can be involved in the business. So that again will be covered by the webinar tomorrow from a tax perspective. As I said before, just be careful. They don't always have expertise to bring along. Sometimes they just have money and they want to roll their money. They want to invest into a tax scheme that after 3 years allows them to have tax-free gains and then to effectively invest again. From the venture capital side, as I've already said, they tend to invest more, but they most certainly look for those special businesses and tend to invest at a latter stage. There are investors out there in the VC market that will invest a lower amount, but again, very competitive, and you have to be at the really be at the forefront of your space, and it has to be a scalable venture. So that doesn't mean it has to be profitable. It just means that if 5, 10 million, 20 million went into that business, you would not be capped by the market size. You can keep on going and you can become international. And they also like to see the traction there. Okay, so on to next, we'll just do another quick check. So again, in terms of investment levels, typically at this stage of business, you're looking at check sizes between that 25k and 2 million per angel, per venture capital investor. Regarding the rounds, I'm sure you all know about this, but it tends to start in this order. They are so different for every single business. When you first start out, if you're lucky enough to have friends and family that can put money in, fantastic, do so. When you get to effectively pre-seed, again, you might have an idea, you might have more than that, you might have the financials worked out, you might have your deck, you might have an MVP. What you're effectively looking for then, it can mix with seed, it depends on the stage that you're at. Again, you're looking for angels and that network to invest. When you get to Series A, you're typically into the VC world. So that's a very, very short summary of the investment rounds. With regards to angels, as I said before, typically in the UK, they want EIS as a minimum. If they get SEIS, even better, they get more tax breaks. And in terms of their investment cycles, they have to invest for a minimum of 3 years to get the tax breaks. The VCs, you're often looking at a 3 to 5 year cycle. Some of them are longer, it depends, and they also offer follow-on funding. In terms of returns, often there's a misconception. So most people think that VCs, because they look for such a high return, it means that effectively they will value the company differently to an angel. So they think that if they go with an angel, they'll retain more, the founder will retain more equity. Not always the case. You have to be very careful early on, because there are angels out there, supposedly angels, that will look to take a huge chunk of your business because you're early stage and give every excuse for that. And what that restricts you from doing is, in the latter rounds, so the Series A, the Series B, it restricts you from raising further funds, and it will effectively dilute the founders' shareholders to such a small amount in the business that it will be unattractive to people coming in, to investors coming in. So you just have to be careful of that. And again, any of these points, do feel free to ask a question and fire that through. I'm sure that John, Josh, or Chris will highlight any major questions that are coming through.
Yeah, Michael, we've got a couple of questions in the chat.
Okay.
So you're right to answer a couple of those.
Absolutely.
I've got one from Jim from Tethered Drone Systems. So he says, we're an innovative technology company, having had over 2 years of R&D. We're now looking to raise funds to take us to the next level. We're finding angel investors being reluctant this year to take a punt on the technology. All seem to be looking at the initial list of companies that we put up at the start. How do they get them to invest with them?
That's a very good question. And whilst there's a little bit of context there, there's not a huge amount. I suppose what I would say there is, where have you been trying to raise the money from? So angels are not the same. If you are in a specialized area, which you are, what I would say is there are specific angels in the world, not just in the UK, not just in your city. There are specific angels in the world that will like this area. And if you're not approaching those specific angels, it might scare other people. So for what you do, again, I'm not an expert in this area, but I know a little bit. So I believe that you need a commercial license and so on. If you were to look up people that have invested into other drone businesses, that might be a starting point, providing you're not sharing any trade secrets with them or any technology. You do have to be careful of that, of course. There's lots of angels out there that effectively are building up portfolios because they have an eye on merging investments, not tons, but there are some. Certainly we're a specialist. But what I would say there is, look up if there are any angels that are specific to your sector, because where it's a typical business and a good investment for most, you often want to raise from local angel groups. Where it becomes specialist, seriously specialist, as it appears that yours is, you either need to check who the investors are within your local angel group, or you need to seek support to get those investors to your angel group, or you have to go outside of it and approach them. So what I would say there is a conversation with John to see who the investors are registered at the moment, and to identify whether any of those are specific to your sector, have any knowledge of drones, have any interest in that, and effectively then go forward from there. If you are looking at the VC angle, because again, without looking at the business, it might be quite, you could have some incredible tech there from what you said. From the VC angle, again, there are VCs out there that look at very early stage. However, they might want to see a bit more traction, and that's why you're in this angel round. So it's a chicken and egg. Again, if you want me to have a quick look at the end, I'm happy to. I'm sure we can have a conversation with John involved as well and try and understand why you're struggling with that. There could also be a second point here, and that's how are you delivering your pitch and how are you valuing the business? How, what is the quality of the management team? What's the background? There are lots of other things. What's the quality of earnings going forward? How long will this be loss making? So for angels, they are looking for businesses to grow. So how do you value a business like this? After the 3 years, will it allow them to exit? If they want to exit at that point, will it allow them to realize their investment? Is it a longer term play? So many questions around it. And I could go on all day. So I won't on this particular question. Is just given an MOD, okay. Okay, so again, the patent's pending, really interesting. What I would suggest is that we have, it's very specific, your question. So it's more for a separate conversation, but more than happy to take 10 or 15 minutes at the end and to talk through it. If you've got sight of revenue, which clearly you've got contracts signed there, again, that can be really enticing to angel investors coming in. But again, it links to every other part. So it links to quality of the management team. It links to the quality of the earnings going forward. It links to the overall business plan and where you're trying to get to. Valuation, as I've said already. Okay, we can pick that one up at the end. Are there any, Josh, Chris, any other questions there that we should pick up at this point?
We've got one more, which you may be coming to in a moment. But so in terms of timing and kind of when to set an investment strategy for the first time, the question is, do we set that when we have client supporting growth, or do we enter earlier? When's the sweet spot?
And we are coming on to that, and I will be going into it in detail. But a very quick answer to that is, it depends on your business. If you have innovative tech or innovative anything, it could be a material that you've invented, it could be something that's patented, it could be all sorts of different things. Then often what investors like to see is sight of a contract, at least. So whether that's proof of concepts plus letter of intent or MOUs, those are really valuable when you're seeking investment. It also puts you in a position of power to support your valuation. If, however, you're wanting to get a better valuation, then of course you can wait. But if you can't afford to wait, then you're just going to have to go for it. Is how I would say it. Again, it's another one where it needs some context around it, and for each business, every business is different, every funding round is different. It needs looking at, it needs assessing who the investors are in that space, and effectively, again, if there's some context they want to put around that, I'm more than happy to share some, spend some time at the end and share some thoughts. So I'll just go back. In terms of Q&A, we'll come back onto a Q&A. We're going to do about 3 sections of those, so don't worry, we're coming back onto it. I'm going to try and fly through the slides. Do hurry me up if need be. I know I'm terrible for talking on. So we're back onto slides and valuation expectations. See, this is the bit that I always find most interesting when I'm talking to potential or founders that are looking to raise. It's very important that you look at the valuation methodologies used from a VC or an early stage PE house, or from an angel investor. There's definitely an element. So I've put three different core metrics here. You may well have only heard of DCF, because most people love DCF. They think that they get the best valuation from it. They get the best. Effectively, you can put in all of your assumptions. As with most things, it's based on assumptions. Your forecasts are based on assumptions. As long as everything's backed up, the valuation methodology will just depend on who the buyer is and how they see it. If you put a valuation on it, doesn't mean it's what they're going to pay. The way that we look at things when we're trying to raise money at this stage. So first of all, there's an element of psychology. It doesn't always have to stick to this. It can be lower, it can be higher, but there's definitely an element of, does that person want 5, 10, 20% of your business? And when we're raising, certainly through VCs at the earlier stage, they tend to want, whilst a minority, not a significant minority, they want a minority stake in the business. When it comes to the second leg of the three, they will often look at a multiple of either ARR, if it's a tech business, let's say, or a multiple of EBITDA or sight of the EBITDA, and an assumption based on the fact you're going to get there. So in order to get to that, which I'm going to go into again more detail, it's a market valuation. So look at other businesses that have arrived at raising money and what multiples they achieved. It's what stage of business you're at, so you adjust the multiple for it. It's effectively whether, what costs you have in the business, how much you need to raise, whether it's realistic. And effectively, when we're looking at things like profit and also ARR, if it's not backed up by contracts or not backed up by something that's signed, there's always some skepticism. So whatever you write down, they will never value it to that point unless they think it's a fantastic deal. There will always be an element of chipping. The final one, which I think is most important for any investor, is the investor returns. So if an investor is investing 100, let's say they're investing into a business, your business, and you're saying it's worth £1 million at an early stage. and they invest for 10%, very simple, really simple math. They invest £100,000 because they get SEIS or EIS tax relief. They invest £100,000. In 3 or 5 years' time, 3 years for EIS, let's say, at least 3 years, they want to exit, and your business is now valued, remember we're talking about value, at 10 million, they will return £1 million based on 10%. So they invested 100,000, they're now up to £1 million because they've got 10% of a £10 million business. What they must take into account, which we'll come on to, are the terms that go alongside that. So will there be any dilution in that time? Will they raise further funds and be diluted, and therefore they won't realise £1 million? In actual fact, they will realise a much smaller amount. Looking at that, they would receive 10 times their original money, which, by the way, is a phenomenal return for any investor, certainly for angels. Where you get the odd one that goes to 100 or 200 times, they really are the unicorns and the really special businesses, and that's what everyone's chasing. Across most portfolios, it's a much lower return. You would have to invest in a couple of dead ducks before you get a 10 times return. Okay, so hopefully that came across okay. Again, if you've got any questions around the investor returns, how it links to the other areas, how it links to the minimum amount of equity, how it links to the multiple of ARR, annual recurring revenue, that is, sorry, or EBITDA, which is effectively net profit, a proxy for, then do just fire those over. Just on investor returns, again, pitch it to the right investor. If you believe that angel is looking for just a reasonable return on their EIS money, pitch it at 10 times. If you pitch your business at 100 times, then you really should be looking at the VC market, because that's what they're looking for. They're looking for scale-up businesses that can achieve 100 times. Yes, an angel would love to be involved in that, but there's an element of being realistic for the business and realistic for the growth. So again, it's about just assessing all options and making sure that you are covered with regards to the overall potential of the business. DCFs, as I said, they can come into it. Discounted cash flow valuations, much more complex. Again, we sometimes do them. Investment banks tend to do them for, again, technology companies that are scaling. Very difficult to do early on because the assumptions aren't there historically. And then the final thing is convertibles. So that's effectively saying, well, we're a bit worried about what the valuation is today, but when we do get to a certain point, what we'll do is, if you invest today, you can have what's called a convertible equity, or convertible loan sometimes. There's lots of different instruments that they use. And they normally state that, okay, if you raise money within 2 years, 3 years, you can buy shares at that point and you can get a discount on those shares. So it's based on the future valuation. So you believe that your company in the future will get to the valuation of 10 million, let's say, in 3 years. And when a new investor comes in, they might be buying the shares at a certain value. They might, for every pound that they buy their shares, the investor that invested early will get 20 or 30% off that price. So they get the discount there. It doesn't put valuation on your business today, but often there's terms associated to it that mean you will effectively, if you don't raise the money, it will normally convert into equity and normally take quite a large chunk of the equity in the business. So you do have to be really careful regarding the timings of things like convertibles. They're quite complex. Okay, I'm racing through these slides because I think that they're covered on one of the other sessions, but this is really where we come into our own, and this is where we add a lot of value to raises that we're working on. So what we do is we tend to build an equity story. It covers all of these areas. Most of you will cover these in your deck, or your business plan, or your IM. There's lots of different words for these documents. Ultimately, for us, what we want to see the market. How big is it? Is it growing? What are the key drivers in the market? Have you looked those up? Are they, what is the SAM? What is the SOM? The serviceable addressable market, and so on. If you are selling, let's say you are selling a food app, let's say, so to order food in restaurants, which is quite a popular thing at the moment. Realistically, there's lots of competition in that market. You cannot say that your entire market is the entire food and beverages market in the UK or globally. You have to be realistic, and you have to look at, okay, which venues require this service, so which are actually going to transform regarding tech. Are they going to continue with waiters and waitresses? Or are you going to, and again, just being realistic about where your business can get to. So are you going to get to 100% of that market? It almost never happens. You're not going to be a monopoly. But realistically, what can you achieve? And is there any precedence for that? So if you're aiming for, say, 5% of a market, how are you going to get there? Has someone else already done it? What is the shape of that market, and who are your competitors? Also, who are the buyers, of course? Management, clear leaders. We always look for people with a bit of charisma, a bit of expertise. Is there a board? Well, early stage, there's often not. But to be honest, we're seeing more and more that have. They've got an advisory board. Be careful about having too many people on it. The cost of that, not only the cost, but also the fact that it's not believable for a very, very early stage business to have a huge board and to be paying them. There's a lot of people that just pay people to be advisors so that their name can go against it. I'm always reluctant with those. It's still very nice, and it's nice that people put their name to it, but just, don't just do it for the sake of doing it, is what I'm trying to get across. Operational team, very important. Of course, if you're building something, if you're offering a service, you want to have good people in good roles that could potentially, at some point, if you're thinking about the far future, potentially be part of either a sweet equity pot where you give them equity in the business for free, or an EMI scheme or something else that incentivizes them to stay with the business and grow. That's always favorably thought of by both angels and VCs. Profits and cash. You need to get all of your figures right. You need a 3-statement model. You need to demonstrate how much cash. A lot of people use cash burn. I hate the term, but it does tell you whether a business is going for the growth model, which is effectively just burn through cash, make lots of losses, just raise money for it, or whether they're aiming to be profitable and actually just grow organically. It gives you an idea. What your margins are as well. So whether you are a true tech company achieving 80-90% gross margins, or whether you are a tech-enabled business, maybe 60-70% gross margins, really important to understand for any investor. On your platform, tech roadmap or roadmap for any business, really important. Seeing what you're going to develop and what you're going to use the money that you're raising for is absolutely vital to any investor. Never go in and just say, I'm going to spend it on marketing, sales, that's it. It will not be a long conversation. You need to really drill down on what you're trying to spend the money on. I've already covered positioning in terms of the market as well. Okay, so that's just a summary there with a nice picture and a nice bit of BDO branding. Lots of red for some reason. Okay, so forecasts, again, I'm going to skip over these relatively quickly. Just very, very much all the things that we look for: P&L, cash flow, balance sheet. We like it split down monthly, at least 3 years, preferably 5 years if it's a 5-year investment cycle that they're looking for. The latter years, of course, will be broad brush assumptions, but it's good to put them in. It's easy to do as well. KPIs for the business. What are you looking for? If you're a gym, maybe you're looking at number of memberships. If you are a tech business, maybe it's not just number of clients, maybe it's number of users, things like that. It's the KPIs that are important and also linked to your pricing model. Sensitivities, again, what I said before, if your costs go up and your revenue goes down, what happens to the business? Is it sustainable? Are you raising enough money? And understanding when the next raise is due to be as well. So standing up to scrutiny, again, this is all about the things that I went through before. It's about having a plan B. If this goes wrong, what's going to happen? Can you react? You will change. No business stays the same from the start. Most businesses change in the early stages and find where their core market is and what their core product should be. Customer insights. These are really good. I enjoy these a lot. So we often see customer acquisition costs, lifetime values, loads of acronyms that most people spend a lot of time getting their head around and calculating, churn, things like that, which are all important. But actually, when you're at very early stages, they're almost insignificant with regards to the fact that the business is so early stage. The founder is often doing most of these things, so the costs aren't accurate. Once you reach an inflection point where you've got a sales team, where you've got a marketing team, where you've got all of these other costs in the business and you've raised money, at that point the metrics become more realistic. But certainly, you know, from a customer acquisition cost, if the founder's done it themselves and they say, well, there's no customer acquisition cost, well, it's just not going to be true going forward. Lifetime values, again, very difficult to know early on. You have to see that through a little while. You can make assumptions, absolutely, and people do, but little weight is put on these, I would say. Certainly at the early stage, they factor in, but they certainly won't make the. They're not going to sell it on their own. Business systems, more for the latter stage companies, but if you can start it early, absolutely do so. So all of this links to both VCs and angels, by the way. I'm flying through it because it's important. Having robust systems, have a book that covers every process and every system in your business. You will not regret it. Everything everyone does, have it noted down, you know, a Bible for the business. What that then does is anyone coming in at any point knows that someone can effectively replace a particular role and the value is still there. They know how to do it. Very, very, very important. Again, things on KPIs, decision making, making sure that the funds are set out and when they're going to be spent. And again, on that final point, disjointed and bespoke systems are as bad as no systems. It's not always true. Some bespoke systems are fantastic and revolutionary, but for the most part, that's a very generic statement. Okay, so market size, we've already covered a lot of this, but in effect, you just want to see if it's restricting growth, where you're positioned, management are capable of achieving that market. You don't need anyone else to come in and support it, or if you do, identify who that is. Maybe it's a sales director, maybe it's partnering with someone, identifying it. Back to the core, back to the angel and VC. How are you getting there? Well, you've already made the right decision. You're part of an angel network, just right here. That's why you're here. And if you're not, then you should speak to the guy, speak to John. So pitch events are really good. Much easier at the moment. You can do things like this. You don't even have to commute there. You can do it via video call. There's tons of opportunities to do that. You can meet lots of investors. It's just about, again, speak to John. He'll advise. He will advise. It's why investors are coming to. It's like why investors are coming to these types of angel groups. Awards, vanity, but equally they get people recognised. So I wouldn't go for loads of them, but if you get a couple of key awards, it's always nice, and it demonstrates that you are leading in a certain area. We often look at that as a nice to have rather than a necessity. But often at the earlier stages, it can win you your first contract, or it can win you your first investor. Things like incubators, a little bit different to angel groups, of course. These are normally offices or banks or other corporates that might offer, whether it's a desk or advice over a period of time. You sometimes have to pay for these. They sometimes link to a VC and link to investment. Again, it's another option and an option that a lot of small businesses go for. Maybe not quite as much at the moment, given COVID, everything has gone online. Warm and cold introductions. Warm, always better. Obvious, absolutely, but it's true. If you are being introduced to an investor, if someone can vouch for you or someone gives a second opinion on it, of course it's going to be better than you just getting in touch with them cold. Very few people like that approach, albeit it can show a bit of initiative. So there's a fine line to consider. The final one's probably advisors and people like myself. I see a lot of early stage businesses. I don't work with them so much anymore. There's very few that we work with that we believe will raise the 2 million plus, 3 million plus at that early stage, and that means that we effectively end up with a lot of referrals out to investors. We don't engage with them, but what we do is we'll review it. We'll look at whether it's something for the future. We'll make an introduction for the early stage investors. And then hopefully over time we've built that relationship, and we'll work on the next round with them. Pitching, stick to a time limit. I'm probably a bad example of this because we're about 13 minutes away from the end of this, and I think we've got quite a few slides to go through and a Q&A session. So what I would say is stick to the time that they give you, because you want to get the key information across. If you can attend events, sometimes people are cheeky and they go over it, and absolutely that's fine, but there's definitely a lack of discipline if you go over it, and I don't think it's always appealing to see that. Again, know your audience. don't waste time going to events that don't have the right audience for you. And that can often just be a case of asking the event organizer who's going to be at this. If they don't know, then okay, you might well be worth turning up. And people always know people, so they might see it. There might not be someone in the audience for you, but a lot of angels do know other angels, and they will pass on the details and say, might be worth you looking at this one. And again, John can give some more guidance on that. Again, back onto the fact that we're on virtual now. So I think we've got a couple more questions to go through. I'm going to come on to those in a moment when we get to the next poll. Yeah, so the other final thing on this is platforms. So you won't see them, but professional investors and advisors do see them. The deal databases such as Berger and Market IQ and so on, and also the press for early stage businesses pick up on high growth. So if your accounts are filed and it can see high growth in those, if you're part of incubators, if you win awards, there's lots of things they pick up on. They scan the web and they see these things. They API into Companies House, they scan the web. So again, it's another method of when investors are identifying their lists that they want to speak to, it's another method of getting in front of them and demonstrating you're a good business. Onto the trickier area, which again, these are areas that we look at from a commercial side, not from a legal side. We're not corporate lawyers. We're chartered accountants or XP investors. There's a difference. But I just want to go over them fairly briefly. Both VCs and angels will put in place a term sheet and a shareholders agreement if they're acting professionally. Some angels don't, but I don't think we're in that world anymore. So effectively, a term sheet is the offer. Once you've had a couple of meetings, you have a term sheet. It will tell you about them. It will tell you exactly what the deal looks like. Not typically legally binding, apart from exclusivity usually and confidentiality. What you then have is a shareholders agreement, which often isn't done until completion. So that's effectively to say that the shareholders have the right procedures should someone want to leave, should someone pass away, for instance, key leaver provisions. And that I would recommend in any business from the start if you've got multiple founders and should something happen. So restrictive terms, this is very, very high level, but I'm going to go through these in quite an order just to give you some ideas. This is where it gets complicated. So you receive a term sheet and you see things in here from angels. These are often a lot shorter. They're often not putting quite as many restrictive terms in. They're often just, and if the tax, for instance, EIS, often doesn't allow them to put certain terms into their agreements. However, VCs operate on a different level. So first of all, you should know what the cap table looks like. If preference shares are asked for, what that means is should there be a liquidation of the company, or if there should be a sale, they get paid first before your shares, before the ordinary shares. Liquidation multiples, again, almost quite similar. So effectively, they will get paid X times their money. 1 times the money, 2 times their money. We often see 1 times in VC agreements. Anti-dilution ratchets, again, it's about down rounds. So if they invest today and next year they effectively, you have to raise more money, but you raise it at a lower amount, you have to issue more shares to make sure that they don't go from 10% down to 5%. They have to retain that 10%. We see that in probably maybe a third of deals. A lot of VC deals do include it now, which is actually quite disruptive to the future rounds, especially when you don't know what the climate's going to be, COVID and so on, and the impacts on valuations. The next one is tranched investments. So this can be in different methods. So you could potentially be raising 500k today, 200k today, whatever it might be from both VCs and angels do this. The best way to do this is if you can effectively agree that the money you invested today is at today's valuation, and if you have some traction in the meantime and improve the valuation, the next tranche of money in 12 months' time, or when you hit a certain milestone, will be at a better valuation and therefore lower dilution. Why is that attractive? Well, the angel or the VC is not risking as much day one. However, in 12 months' time, of course, you might not hit that milestone and you might not receive the next funds, and that could be an issue. In terms of the rest, these do get into very legal areas, but just to give you an idea, I mean, I've written the brief summaries on here. I think probably the key ones for me would be lever provisions, making sure that if when you're negotiating these, you know, very bad lever, things like fraud or gross misconduct will always be there. You know, and what they specifically say for a lever provision can sometimes be that you have to walk away and they buy your shares for £1. Not always the case. Sometimes they're generous. Sometimes they just put a discount on it. Sometimes they give you market value. But market value without you in the business will be different to you in the business. Drag along and tag along rights. Again, this is about the timing of that next round or the timing of the sale. So if you retain majority, you can choose when you're selling, and tag along part is for minorities. So if you're a minority sat on a board, you don't want to be there and see that the majority's managed to sell, but you're sat there stuck with your shares with this new investor coming in. Tag along rights effectively give you the right to do the same deal. What's the difference? As I alluded to before, they're a lot simpler when it comes to angel terms. Now, there are years gone by some really nasty terms within VC and angel, but more VC term sheets. The liquidation multiples can be higher. If you see a liquidation multiple above 1, you're probably in the lower percentile of people that receive that, and then it's about just matching it up with the risk that they're taking. So is it worthwhile? Is it worthwhile going ahead with this? Again, all of this needs an advisor. Well, doesn't need an advisor, but it needs someone with knowledge to go through it, and certainly corporate lawyer from a legal angle, and someone commercial, potentially an advisor to support you. Okay, so that's enough of me pretending to be a solicitor for a moment. We're on to our next poll. Hopefully we can go through this in a couple of questions. There's not too many more slides. Josh, Chris, do you want to put the next poll on? Okay, so what we're asking here is effectively, who are you trying to get investment from, and in what order? And this might give me an idea as to what stage your business is at as well. A lot of really sensible answers so far. Okay, any more? Perfect. Excellent. So a lot of you have got that right. Absolutely, angel or angel and then a VC, or don't know. Well, it's probably going to be angel and then a VC or some other form. It's interesting that none of you have put VC. Doesn't mean there aren't VCs out there for you. I'm not trying to talk you away from that side at all, but typically the route is angel and then VC. You have to be very, very special, have to be very scalable, and all of your metrics need to be spot on in order for you to go straight into a VC. Okay, so John, Josh, Chris, do we have any questions at this stage?
Yes, we do. We have one question in the Q&A. So this is a question from Don saying, I'm assuming that tranche investments wouldn't work with the future fund.
No, it doesn't. So the future fund, you have to have raised the money prior to effectively the start of COVID, or just prior to its launch, and you then need to have a lead investor offering over 50% or more of the money on a convertible loan note basis. The only negotiation points on it are the percentage interest rate, which is 8% or higher, and the discount from the next round, which is 20% or higher, and everyone has to be on the same terms. You cannot put more money into it at a later date. It also isn't compatible with EIS or SEIS or VCT. Does that answer your question?
I believe that does. And Michael, we have another question. This is relating to raising funding for the completion of a project. So clearly it's gone through an R&D stage and it's coming to the end of its R&D stage before commercialization. That's how I read it. They're looking to say what kind of percentage is involved with angels and how long would it take to take effect?
So is that in terms of the amount of equity that an angel would take? Sorry, John.
Yes.
It absolutely varies. So if you're in a strong position in terms of your valuation, if you can back up the assumptions that you've pulled together, so whether that's contracts going forward, as you know, or like you say, you've got some IP there that you believe will transform the business, you've got a strong management team, quality of earnings demonstrated, all of these other areas, you're then in a position to negotiate. There's definitely an element of art or science when it comes to evaluation, certainly at the early stage, because no one knows. Everyone is taking a risk. So all I'd avoid is, if you can keep it to a minimum amount of equity, it allows you to then raise again and allows you to not be diluted. If you get to the Series A round and you're on 30%, if you only own management as a whole, own 30% of the business, it becomes unrealistic for future fundraisers, because you're just going to end up with such a small stake in the business. There's plenty of rounds after Series A as well. You've just got to be very, very careful not to give away very much. And again, if that's a case of they're asking for too much, then it might not be the right deal for you. Okay. So I'll I appreciate we're almost on time, so I'm just going to fly through the last few slides. So deal timetable, again, you know, this is just an outline. Get your documents ready, investor readiness, really key, preparation, financial models, and so on. All of this is just a recap of where we were before. So due diligence, when they go through it, at the early stage, it's very, very simple. It can often just be commercial and financial. The other areas tend to be where you've got a more complex business. Sometimes, you know, technical, for instance, if you've got intellectual property, they hire someone that's specialist to go through that and make sure it's real. On the commercial side, often it's a fairly straightforward review at an early stage. Legal, there's always corporate lawyers involved in any deal, so there will be an element of this. And then financial, of course, if you're very, very early stage and you're not started making any money, it'll just be looking through the assumptions. Last slide before a true Q&A, which we'll have to go over time for. Dragon's Den. So supported a business a few years ago that was successful on Dragon's Den. We negotiated with one of the dragons, and we actually had 3 businesses that went onto it. Two of the others got offers and fell over during due diligence, because the offers were then subsequently changed due to findings in the due diligence. So it's not always the answer. What do you get from it? Well, firstly, you get, of course, your charm and charisma goes a long way. If they like you, they will typically invest. It's not always a true business decision. I've seen from watching it, there's an element of if you can charm a lot of people, you tend to sell products. You're a sellable person. You get the audience straight away. So if you're a product or an app, often you get a lot of downloads that week. You'll see your marketing spike throughout the week. The key things that I think are quite poor. Their valuations are very poor. They value themselves really highly. They think they can make a difference to every single business, and often, where they're the really special businesses, they don't add all of that value. It's the management team that are so good. There's the odd example where they bought, you know, a couple of %, but it's so few and far between. From a risk perspective, embarrassment, of course, you can embarrass yourself, and it's on national TV and forever there in the archives. Credibility to other investors if they've seen it. Most investors do watch it, even though they laugh at it. You don't raise enough. Again, same problems as we said before. You've given away too much equity because the valuation wasn't high. There's still due diligence, so they might put you on the, you know, they don't tend to put you on the program unless I think it's agreed. So they won't ever show something that's not gone through DD, but there's still that risk. With regards to contacts, of course, they are phenomenally well connected. And you know, from my experience, which was a gin company, where we supported them with the negotiations. Ultimately, what was really interesting was some of the negotiations for both the client and the other side. It was just about around common sense. So where you've got a restriction maybe on the salary that you take out of one of these businesses, which most people want, they want either a dividend policy or a salary cap. Because it's an early stage business, they're putting in some money. They don't want you to just take it out and spend it. They want you to spend it on the business. If that business makes money and is profitable, you can take out a dividend as long as you've got the right agreement in place. So that's the most important thing. So what you should always agree is, whether it's an angel, whether it's another investor, what happens with the dividend. VCs are often wanting that to be reinvested. They agree a salary with you. Angels might be a bit different, and certainly dragons are different. The other thing I'll note on this is, and to my surprise, was it's not always the dragon that deals with it. They have portfolio people that deal with their investments, and it's surprising that some of those perhaps don't know the debt market as well as others. So they still require external advisors throughout that process to then raise a couple of, whether it's debt rounds or equity rounds subsequently. So quite an interesting area. But if you've got the right products, and you're the right people, right style of person, it can be a great route. Okay, on to a final poll and Q&A. I think, to be honest, we've already done this one, but this one here: are you going to change your strategy? That one is would be interesting for me to learn. No, very good. Not sure. Okay. Couple of yeses. Excellent. Okay, so it's quite a split across yes, no, and not sure. I hope that you've learned something throughout this. I hope it's been useful for you. We're going to go on to a Q&A effectively now. So, in summary, there you've got my contact details here. You've got my LinkedIn if you want to link in with me. I'm always happy to look at things. Obviously, I can't look at everything. We see probably 200 plus businesses a year, meet with them, and we try and look at things that are coming through just because they could always result in a larger raise later on. So I'm always happy to provide some thoughts. John, Josh, Chris, I'm gonna hand over to you for asking some questions on the Q&A. But just before I do, given we've gone over time, just want to thank everyone for attending. If you've got to dart off, thanks so much, and the best of luck with the raise.
Thank you, Michael. You've been an excellent presenter, and we will invite you back again. I've just got a couple of questions which came through. I mean, to summarise a number of the questions which have come through, I think I can summarise it with one simple question. In simple terms, how do you value a tech business?
It's an art and a science. If it's a true tech business and you can demonstrate the high margins, then typically, so you go for two methods. There is the DCF you can always use, and what you'll often find is valuation is not one method, it's several methods, and then it's a range. So you can do it in a few different ways, and then you'll look at, okay, well, this one gave me X million, this one gave me X million, this is the range, and as long as we get somewhere between that, then you're okay. Often when we're looking at something simplistically, it's annual recurring revenue, which most tech companies are striving for. So that can be a SaaS basis. It can be long-term contracts. It can be a commercial, but the commercial product, there's a link to this. Commercial products has to be sticky. So if you've got high churn, then ultimately you're going to struggle to value your business on the full amount of the ARR. So let's say you get to 500k of ARR, annual recurring revenue, and you've got customers that are dropping off the platform or whatever it is you're selling as a tech company, then you have to factor that into the calculation. So if you're only churning a few percent, then they'll probably give you the benefit of the doubt and just base it on the full amount. So it'll be a multiple, whatever that might be. Maybe it's 3, maybe it's 8. It all depends on the other criteria that we've said before. Have a compelling investor story, and then on top of that, it's the other thing. So it's what's the return for the investor? If they put X million in today and get X amount of equity, will they make 5 or 10 times their money over a period of time? The type of investors we tend to work with at this stage, often we're looking at lower returns if it's at the sort of the private equity side rather than venture capital. 3 times is quite a nice return for those VCTs as well. But they do like certain investments to make 10 times or 100 times. Of course, who wouldn't? So that answers that question. Okay, and finally, the $6 million question, which you get a bonus prize for, is when does an angel work better compared to a VC? An angel, well, if you can get angels in that are, it's terrible to say, but there's a lot of angels out there that are just interested in the tax schemes. And there's a few different answers to this. First one is, if they're just interested in the tax schemes, then often they're a little bit blinded. So there are other platforms out there, equity crowdfunding and so on, where people aren't sophisticated. They're not looking at how you valued your business. They just think, as long as other people invest, I'll invest as well. That also happens on these angel networks, but they're slightly more sophisticated. So you can have that. The problem with that is it's a capital only approach. You are not getting any expertise, you are not getting any help. Where you've got the flip side to that, you might get an angel that has the right contacts that land you your first few deals, or they might bring in someone that lands you first, helps you to bring in the right management team, let's say, makes the right connection that allows you to develop your product to a better point. All those different added, value adds are, you can't necessarily just base that on how much equity they've got. If an angel comes in and provides that guidance, there's a lot to be said for it. And a VC, some VCs will do that, absolutely. But there are certain angels out there that are fantastic, know what they're doing, know how to scale a business. They've been there, done it. They can end up being a friend. They can end up being a mentor. There's a lot of value add from those contacts, and that of course can be a better scenario than going the VC route, which has all sorts of onerous, further onerous terms, probably a longer process. Most angels can get into it quite quickly. They're the ones controlling their money. These VCs tend to be a fund, and they have to go through an investment committee process.
Thank you, Michael. Thank you so much. That's a lovely presentation. And yes, videos of this will be available shortly after the event. Please be patient. And can I remind everybody that we have the really interesting subject of tax and the benefits to investors and to entrepreneurs of SEIS and EIS in much greater detail. And they are important because to understand the tax implications and why investors invest, as Michael said, some investors invest for tax reasons. It's important to understand where you fit in the process. So that is tomorrow at 2 o'clock, and I look forward to welcoming you to that. So I would like to say thank you to the panelists today, and I would like to thank our guests who attended, and I look forward to seeing you at our next webinar. Thank you very much indeed.